Alright guys, welcome on this video where we're going to be talking about structure, where we're going to be talking about trends. And as you can see guys, we are having on this screen, we're having right now the uptrend on the left and we have a downtrend on the right side of the screen. Now let's talk a little bit about bullish uptrend, right? Now basics concepts, we definitely know that we are going to have a higher high formations and higher lows, right? The market is going to be moving upwards. That means that it's going to creating a higher highs, and you can see that now that we are having a higher low formatted over here, we are expecting market to become bullish and to go over this previous higher high. And then of course after the market is going to complete that phase, there's going to be another retracement with possibility of another higher low, and that's way we know that the market is bullish. Everything goes literally just a mirror image to the downtrend when we are talking market moving lower, right? We are expecting for market to not trade any highs, so we're going to be having a lower highs and we are going to rating lows. That means we're going to creating a lower low formations, right? Now every single time we see this stuff happening in the marketplace, we have a really good healthy range and healthy structure, which inside of we can find any good trades. Now where and when the retracement can happen. Every single time when we're talking about uptrend or downtrend, every single time a new higher high is set or a new lower low is set, there could be market going into retracement mode, right? And when we are talking about the retracement, it's kind of like a natural reaction after a previous high or previous low is actually broken, right? And then we have a retracement where we potentially are seeing any good opportunities, right? So that's why if we move towards this is where a retracement is actually happening, and this is where we are expecting a retracement to come and giving us a potential re-entry, right? So we know 3 points inside of the market structure that for now we call them a concepts that of course can give us any good setups. And we have institutional candlestick, which can in fact be also the FU candlestick. We're talking about mitigation candlestick, and we're talking about imbalance. All three of those concepts can work, and we are usually expecting for market to create a retracement up to that point. Now, most common between everybody is institutional candlestick. It's literally the less candlestick, less bullish candlestick in this example before the market move lower, right? And that's literally the candlestick that it also exists at the top, right? Sometimes we're gonna see market just feel the imbalance that is going to be a little bit lower than institutional candlestick, right? We can see it right over here, and you're going to see that market just tapping in that imbalance and reversing to the downside. Sometimes we're going to have imbalance in institutional candlestick a little bit higher, and the market is going to reaching back to the mitigation candlestick, right? And mitigation candlestick is literally the last candlestick before market move away, which is that bearish candlestick right over here for this example over here. Now you can see that market is presetting the points where to which point the market could be coming back to. Now a lot of times, right, at least like 90% of the time, retracement, when the retracement is happening, is going for those levels, right? And we need to think about a little bit about orders. What is actually happening there, right? The imbalances are usually created because the market explosively move in one direction, right? That's why we have that imbalances, we have that gaps, right? We have that small portion of the price action that could lead towards a good entry in the future. Then we have mitigation candlestick, which is literally a failed institutional candlestick because we broke through it, which is right over here, right? This is mitigation candlestick, we break through that. And then of course we have almighty the institutional candlestick, which is representing a volume of orders where the market was literally tipping over for going from bullish into a bearish environment, right? And we all know that in that candlestick are definitely heavily selling pressure delivered to the marketplace. Then of course the scale tip over and market become again back to a bearish environment. So whenever we have a retracement, that's usually the 3 points that I'm watching on the high of any range where the market is going to give me a retracement. And deeper the retracement is going to be, the tighter stop loss is going to be, because we usually populating our stop loss above over here. And then if the market is reversing, of course, the higher the market is going to have a retracement, the smaller our stop loss is going to be. And because we are in a downtrend, we are targeting this low down over here. That means that we are in downtrend and we are looking for a new lower low to get set it in. And of course, with lower high right over here, right? This is the expectation. Those 3 points are expectation to which area market could come back up. Now, if we're talking a little bit about retracement, right, we need to talk a little bit about liquidity as well, right? Because we do have two really interesting environments over here, right? We have over here, we have external liquidity, right? And over here, let me just fix this one, right? And the reason why I put this as external liquidity, because let's talk a little about it. So we have a range from this high over here to this low over here. And let's say for some reason we find out that this is a preset low and the market is going to be trying to go higher. That's why we're anticipating this low, and that becomes external liquidity because we are already retracing back inside of the range. Now, we already know which 3 points are we looking at, but if we are really in a downtrend, the market should not go past this dollar sign, which is literally this liquidity that is represented above this high, which we call it external liquidity. So because we are in this range, both of those ends become external liquidity. But because we are in a downtrend range, right, or structure, we are looking to rate external liquidity to the downside. If we rate liquidity to the upside, that could lead into the breakout structure, which we're going to talk a little bit later, right? But that's what we are seeing over here. And this is a good annotation of the fib levels that I personally use, right? And my favorites are 71 and 78.6. Special if around that area, which is this gray box, up to 88 level, I have anything of those 3 points over here. Potentially mitigation candlestick, potentially institutional candlestick, potentially any imbalances, or the best setup, imbalance plus institutional candlestick, meaning that imbalance is a little bit higher over here, for example, right? And that leads towards really like deep retracement, because the market, when it is giving us a retracement, works, or it's kind of like searching for orders that are in really in an area where there is like a really good place to get in, meaning that they're kind of like buying contracts for cents instead of dollar, because they're going into the environment of deep retracement. It's kind of like a discount area, right? So imagine how the market sees the price is just like you see for a potential like your dream car, right? Would you pay normal price, or would you wait if there of course would be a discount on that car, right? Normally you would save money if you wait for the discount. Exactly the same thing happening in the marketplace all the time, right? So when the market is going above 50%, that's literally just searching for something really good above 50%. What is that, right? 61%, right? And then above. So 71 and 78.6 are, for me personally, the best levels to see a deep retracement to, where the market can come back for search for new orders, for orders that are in the discount area, and then that could be leading towards really good entry for then getting in for a short and trading with smart money, getting for that setup, right? And then of course, if we move to the right side, we have something really similar, right? Now we do have a small ranges inside of one big range. That's why I draw something like this, because what the market is actually doing, a lot of times you're going to see that market is creating a little bit like a short high and then giving us a new impulsive range to the downside. Now somebody could be taking this high and saying that this is external liquidity. That's why I put this as an external liquidity. But for me, if you look a little bit bigger picture, let's say for example we have an institutional candlestick or imbalance or mitigation candlestick that still haven't been tested yet over here, we could be saying that this is a internal liquidity. So that's why I'm going to change this into internal, right? Not external, but internal liquidity, right? Because it's between a new, let's say, high and a new lower low, because we are in a downtrend. And then if the market is going back for the liquidity, that could represent, right, again, a good opportunity to purchase more orders to the downside, right? And I have EURUSD over here, perfectly example of exactly that, right? Look, we have this high over here, we have the imbalance, we have institutional candlesticks right over here, right? We could be saying this one, but let's focus on this imbalance and this high over here, because we could be saying that this range is like this. We have new high and we have new low. We kind of like broke the structure, right? Now, if I put this to red so we can see we see this range a little bit better, you can see that market came back down, giving us a short-term high. It did fill up some of the liquidity and also the imbalances, and then move lower and creating that impulsive move down. And because we created a new low, right? That's why I'm saying that, because when the new low is set, the market could start to do a retracement. And inside of this range, we do have this in the liquidity, which is now this high over here, right? So we kind of like now anticipating the market going past this high, right? Because that's liquidity, we have the institutional candlestick, and we have the imbalance. So if we just measure the imbalance, right, with this gray box over here, between this low over here and this high over here, that's the imbalance that is left. Let's talk about what was going on over here and how we could be getting this trade to develop for us. Now, for that, I'm gonna go back down to the 5 minutes so we can talk a little bit about the structure, anticipation, what is actually going on. So we now know that this blue area over here is that high that got just rated. So what the market did, it created a beautiful kind of like equal highs, right? Market spiked through that, captured liquidity, and look what happened. Market broke the structure because it went below this low, right? This is the structure that created a liquidity run, and then the market just gave it to the downside. And when the market is coming back up, it's coming back for the institutional candlestick, and it's coming back to this imbalance. That's the beautiful thing, because we have everything connected to each other. We have the imbalances. Inside of the imbalance is this beautiful FU candlestick. FU candlestick is just an institutional candlestick that broke previous liquidity, right? And you can see we came back in. We could be putting stop loss above over here, and we have a beautiful, beautiful move to the downside, right? And that's how the market is producing this kind of setups. And it's the same concept that we just talked about it, right? We have this range over here from this high to this low, right? We have previous low, so we have a lower low. Now, because we are expecting bearishness, we're anticipating a lower high formation to create, right? Now, because the lower high created right over here where we were talking about, which is a little bit higher in the range, if we move with the fib levels, we can see that that's 71 and 78.6. That's why they are my favorite, especially if there is any concepts that we're teaching inside of those levels. And we have imbalance over here. We have an FU candlestick, which is also could be our institutional candlestick for that matter, right? And it worked beautifully, right? And it's all come down to understanding that when we have something like this happen, and we have those 3 points or 3 concepts above over here that are still open, that could give us a beautiful run above this high. And even if we have an institutional candlestick right over here, sometimes you're gonna find out that the market is gonna go past that just to take liquidity above over here, above the previous high, and coming a little bit deeper in the entire range, which is what we were talking about on the EURUSD example, right? Now the thing is, to better understand kind of like break of structure, or the structure when it's not giving you the confirmations, right? Or for example, if we are in a downtrend, right, the market, of course, we are expecting lower high to be formed and the market going for a lower low formation. That's on the left side right over here. So we know that those 3 points, or on the highs, we know that there are sell orders over here. So whenever we come back into those sell orders, they're getting more and more and more entries. Smart money is getting more and more entries on this new high, which is a lower high, and then the market is expected to go below the low, right? And those orders that are down over here, when we are talking about institutional candlesticks, any imbalances and so on and so forth, should not give any resistance towards a potential reversal in the marketplace, right? Because if you look on the right side, this is where everything can fall apart, because we have a sell orders right over here that's creating a lower high. But then if this doesn't have enough power to generate a new lower low, and if those buy orders over here could be overpowering the sell orders, the market could give us a formation that is going to break the structure, which is when the market is breaking above this high, right? And from that point on, we just have a new higher high, if we compare over here, and we have high low. And we're coming off of, from the bearish environment, sell downtrend, to a buy or bullish uptrend, right? So if you think about the orders, it's going to be easy to determine in which structure we currently are and what we can anticipate. And it's go alongside with my entry, right? For example, if we have a limit over here at the start of this gray box, and the end of the gray box is our stop loss, right? And market came back up, get us filled in, right? We are in a profit when the market is moving back down. So we are anticipating the market should not give us any resistance in those orders. That's how you can confirm if you are in the right direction of the marketplace. Because if the market is coming back down and it's giving you some sort of resistance and going back up towards your entry, you should be either breaking even, or you should be at least taking some partials out, right? And then let the market do its thing. But the thing is, if this kind of thing is forming, and if the buy orders that are below over here that were originated to just create this move higher, and they kind of fail to create a higher high, right? Because we are in a downtrend, they should not create a higher high. But if they come back down and they're giving us resistance and giving us a possibility of a reversal, then that could become the issue if we are in a sell environment, if we have a sell orders in. Because a lot of times we're going to find out that exactly in this kind of concepts, we have reversals happening in the marketplace. When the market is going from a bearish side into the bullish, from bullish side to the bearish, it works in both direction, right? So to kind of like run it up, when we are in a sell environment and we are expecting downtrend, we are expecting for market to create lower highs and lower lows. That's why whenever retracement is going to happen and our concepts is going to working, and if we are in the marketplace for a short, we are expecting that those orders are not going to give us any resistance whatsoever. So we are expecting for market to trade past those. And for no reason, I'm not putting a buy orders over here, because that would be just literally putting those orders in front of a trend. Because we have a downtrend, the market is respecting more sell orders and buy orders. Okay? Now, if there is a condition in the marketplace that market could not create a lower low, right? Whenever the market come back up to any institutional candlestick right over here, or any imbalances, or any mitigation candlesticks, right? I'm not opening another position, but I'm rather to controlling the order that I still have in the marketplace. And at least it should be on break even, because if the market didn't make a lower low, there's a high chance that market is going to create a higher high, which is going to be against you, which is going to be going for your stop loss. And there is no need to have stop losses still open and be exposed to the risk of having a loss if you see that the market is going towards you, right? And if you think the market is going to go past this high, because it's way better to even close some partials out or collapse the entire market if we see the market's going a little bit higher, and then anticipating the next move and reading the structure properly, just like we were saying. Okay, so if you're gonna be looking towards it, this is also a good example how the market is creating a liquidity runs inside of the range. And it's a beautiful thing to understand that sometimes the market just need to go for the liquidity, just like we said over here on the hourly setup on the AUD, right? Because they are trying to reach orders that are originated in this move, right? And you can see when they do that, they kind of like slow down, accumulate orders, create a manipulation, and then that retracement when the market is shifting back to a bearish environment, that's where you grab in, right? You want that break structure, you want that reversal to happen, and then moving lower. Okay, just to like for all of you guys that still have a question in your head, what is the break structure? So when the market created this run higher, it also generated this low. That's where they were buying orders to create this bullish environment over here. Because when market is moving lower and lower and lower, those orders over here are not respected anymore. So that means that market is not respecting bullish orders inside of those institutional candlesticks. And there is a high chance that market is shifting over to a respecting a bearish environment or a bearish orders. So where are the bearish orders? Pretty much right over here, because the market collapsed liquidity right over here. We have the imbalance, we have institutional candlestick, we have a new range. When we come back up, bam, there is our entry, and the rest is just the history, right? So I hope it was clear enough to you guys to understand how this structure works and how you should be reading the structure. And see you guys on the next lesson.